All right, let's talk about DLocal's third quarter 2025 earnings. This is a fascinating story because it's a textbook case of a company reporting what looks like blockbuster growth only to see its stock get absolutely hammered. We're going to unpack exactly what happened and, more importantly, why.
So what is going on here? On November 12th, DLocal dropped numbers that honestly should have sent the stock to the moon. I mean, look at this. Total payment volume, that's TPV, up a massive 59%. Revenue up 52%. They even beat earnings expectations. But the market just hated it. The stock sold off hard, dropping over 13% before the opening bell. So the big question is, why this huge disconnect? To figure that out, we first have to appreciate just how strong the good news really was. Because, make no mistake about it, on the surface, DLocal's growth engine is just firing on all cylinders. For the very first time, their total payment volume crossed the $10 billion mark in a single quarter. That's a 59% jump from last year, which just shows you the incredible momentum they have with their merchants.
And all that volume? Well, it powered a 52% climb in revenue. The thing is, this isn't some one-time fluke. This is the fourth straight quarter that their TPV growth has been over 50%. It just proves that their whole strategy of focusing on these fast-growing emerging markets is really working.
Now this number right here, this is what the bulls absolutely love to see. Net revenue retention at 149%. This is so critical. It tells you that DLocal's existing clients aren't just sticking around. They're actually spending almost 50% more than they did last year. That tells you their product is sticky, it's valuable. So, of course, on the earnings call, the CEO, Pedro Arnt, he's hammering this point home. He called it another record quarter, and he's talking up the strength and diversification of their business. I mean, from his perspective, things couldn't be better.
So, if the growth story is that good, what on earth could scare investors away? Well, let's flip the coin over, because the market wasn't looking at the growth. It was laser-focused on a completely different set of numbers.
And boom, here it is. This is the chart that sent investors running for the exits. Gross margin fell all the way to 37%, down 5 full percentage points from 42% just a year ago. You know, for any high-growth company, a drop in profitability like this is a massive red flag for Wall Street.
And if we dig one layer deeper, this margin squeeze came from a lower net take rate. Now what's that? Well, think of it like this. For every $100 that flows through their system, the take rate is how many cents DLocal actually gets to keep as gross profit. And that rate dipped below 1%. That raises some really tough questions about their pricing power and just how profitable their new business actually is.
So what did management say? Well, they explained it wasn't one single thing, but more like a perfect storm of issues. They lost some business from a big client in Egypt. They got hit by some economic craziness in Argentina, and then they faced a slowdown in Mexico. Just a whole bunch of headwinds hitting all at once. So, as you can imagine, with investors clearly freaking out about profitability, management had to go on the offensive. They came out swinging, basically arguing that these are all just short-term headaches, not a long-term disease. Their message on the call was crystal clear. This pressure on the take rate is not a structural problem with the business itself. They kept calling it temporary volatility, something driven by the specific mix of countries and payments in this one quarter. In other words, they were saying, hey everyone, calm down, this is not the new normal. And to prove they meant it, they backed it up with their full-year guidance. In fact, not only did they reaffirm it, they said they now expect to exceed the high end of their TVP growth target. This is management's way of shouting to the market, hey, look at the bigger picture here. They also made sure to highlight new products that are designed to drive not just future growth, but more importantly, higher margins. Things like their new Buy Now, Pay Later Fuse service are seeing explosive growth, and the hope is that these new initiatives will help fix that take rate and address the core investor concern head-on. So, you've got this epic tug-of-war, right? Incredible growth on one side, but really worrying margin pressure on the other. So, here at Talk Tickers, how are we looking at this, and what are we going to be watching for next quarter? Okay, first, our prediction for Q4. We think TPV and revenue are going to beat estimates again. That growth engine is just too powerful to stop. But the market is not going to care. All eyes, and I mean all eyes, will be on one thing, the net take rate. Until management proves this margin squeeze was just temporary, that stock is in the penalty box. So that leads us to our rating, market perform. The phenomenal growth should put a floor under the stock price, but all this uncertainty around profitability just creates a ceiling. It is a classic show-me story.
And hey, one last thing, and this is really important to remember. All of this is just for informational purposes. This is not financial advice.